Let's talk about LIC Finance and, the case for a chat here being important to get in what the growth outlook for FY19 is. Now, Mira in its latest report says that valuations are reasonable at 16 to 17% ROE, so it makes it a good buy. But let's chat with Vinay Shah, MD and CEO at LIC Housing Finance, and figure out whether it's worth a good buy or not. Vinay, hi, morning. Good to have you on the show. The government has taken various steps to boost the housing industry growth. Do you also see better housing finance growth over the next 2 years? And also, what would be LIC housing strategy to benefit from these rising opportunities?
The market still, as far as mortgages go, it's a very huge market. If we see the CAGR for the last 3-4 years, it's more than 18%, 17-18%. As a percentage of the GDP, this still constitutes only about 9% of the mortgage market. So there's a huge market, and together with that, there's several other factors which have been there. The development of the smart cities, towns, urbanization, young population of 35 years or less, rising income levels of people, the government policies for affordable housing, tax concessions. So I see going ahead also next 2-3 years, the market should again go up by the same percentages of 16, 17, 18%. LIC HFL also has been growing very consistently. Our loan book has shown a growth rate of in excess of 14-15% over last 2-3 years, and going ahead also I see that the trend will continue.
Right. So banks have started hiking MCLR already. Do you see spreads then coming under pressure due to rising MCLR and competition as well heating up?
Naturally, see, if the MCLR goes up, the cost of borrowing will go up. The effect on the margins by such things, it's not only affected by the rising borrowing cost. How much of the transmission of the hike we are able to get it on our portfolio also matters. Not only for us, for all housing finance companies, it depends on basically what is their state of the liability book and also the asset books. For us, I can share with you that our liabilities, about 70-75% are fixed. So that helps us in absorb the rate hike. On the asset side, we have about 70-75% of our book constituting of floating liabilities. So whenever we do a lending rate hike, the hike in the prime lending rate, we are able to pass it on. Currently also, we have done 2 rate hikes. One was done in the month of April of 20 basis points. June we again did it by 10 basis points. So the margins should stabilize.
All right. The government has said INDAS is to be applicable from April 2018 for NBFCs and HFCs. How prepared is LIC Housing for INDAS? Do you see financials and asset quality coming under pressure?
No, we are working on it. We are quite prepared for NDS. And as you said, starting 1st April 2018, we have to follow the INDAS norms. I don't see much of a difference as far as the reporting on the quality of book is concerned. It will more or less remain the same.
Without getting into numbers, share with us the key trends that you have observed in asset quality for LAP book, retail home loan, as well as project finance.
See, I can share with you the overall 17-18 numbers. Our loan book constitutes about 80% of the pure home retail sector. About 14.5 to 15% is LAP and LRD, and 5% is the project finance. As far as the NPAs, the quality of the book risks are concerned, we are very consistent. We have one of the lowest NPAs in the industry. There also the percentages for the retail sector, which comprises of both retail home loans, pure home loans, and the non-core, as we call it. There it has been in the range of 0.7, 0.8, and there it has been in the range of about 0.4, 0.5, and project included, the overall NPA it went up to about 0.78 in the last fiscal. The individual portfolio wise, if I see the LAP, because mostly LAP and LRD we do in the salaried segment itself, and the ticket size is also not very high. There also the ratios are around the same range. Project, in fact, we improved our NPA levels, which had gone slightly higher as compared to Q3 levels of last year. At the end of Q4, we had lowered it. So there also we are seeing good recovery. In fact, currently, recently also, about 15 days back, one of our old accounts it got resolved, and we have got a fair amount of a full amount of principal and some portion of interest also in that resolution.
Okay, your profits though have been under pressure recently, and ROEs for FY 18 also moderated to about 17%. What will be the key focus areas for you to improve profitability and your return ratios as well going forward?
There are 2-3 things that we are aiming at. One, I have already shared with you, that one is the composition of our loan book, our liability book. We have about 70-75% of our liabilities on the fixed side. So that helps us in absorbing the rate hikes and other things. Secondly, 75% of our loans asset side is floating. So once we are able to pass on the rate hike, we get advantage in our margins also. The second important thing is that we are focusing on those areas of marketing, those portfolios where the margins are more. What I mean is LAP side, as also on the project finance bit. Last year, incrementally, I can tell you that for the year last year, we had a share of about 15% as far as our LAP book goes, and the share for the project finance, the overall book, the share is 5%, but for the incremental year, it was about 9% last year. So that doing more business in that segment will add to our margins and interest incomes.
Okay, we'll leave it at that, and hopeful that for LIC Housing Finance, just as the Nomura note indicates, the next quarter would be a better one. Good speaking with you. Thanks much for taking the time out.